Over to you.
Thanks. And keep those texts coming. Everyone is a little bit of a chance for me to win a Ferrari. So, yeah, please keep texting those questions. There's a few trends going on in fund management at the moment. Nick's just talked about some of them. And there's two more that I'm going to talk a little bit about. There's also some color on these trends in the asset class publication that you'll be given to take away today. And that's really a talent move towards boutique fund managers, particularly in fixed income, away from larger fund managers, away from banks. And it's also a greater alignment of liquidity provisions around funds. So funds having longer lockups. So there's a little more factual color on that in the document. But today I'm going to try and tell you why, from a practical perspective, that matters to you as institutional investors and why we think there's quite an interesting win-win here. Now, in my job as head of manager research, obviously I get to meet a lot of fund managers, some of whom, as Nick says, will eventually be extinct, but many of whom are very good, and they will tell us all about the opportunities they're seeing, and obviously they will also tell us about the challenges they're facing. One of the challenges that they've been talking about an awful lot for the past couple of years is the challenge of diminishing liquidity in fixed income markets. And I'm sure this is a topic that you've all heard about, read about in the financial press. Now that's really happening as a result of two things. First, fixed income markets have grown enormously since the crisis. So European high yield has quintupled in size. At the same time, there's a scarcity of capital being deployed within market-making entities. So banks, for a variety of reasons, but through higher capital requirements and increased regulation, have got less appetite to help price discovery within fixed income markets. And what this means is that within the US high yield market, 86% of trading takes place in 100 names. So the other 14% of trading has to deal with the other 1,100 names in the index, and that's without even worrying about all the names that aren't in the index. So what you have is a thin crust of liquid bonds that do trade daily, where there is still some liquidity, where a lot of risk does get passed around, but they also pick up a lot of volatility because of all the trading going on in those. And a large, less liquid core that doesn't trade as much. And over 50% of bonds didn't trade on at least one day last year at all. So with my consultant hat on, that leads me to favor smaller managers. It leads me to look for managers who are effectively operating below this liquidity line where there's problems, where they can only have to buy 25 or 50 million of a position, and it can still be meaningful for investor performance. But there's another mismatch that's going on, I think, as well as this liquidity mismatch, and that is a mismatch between institutional capital and these boutique managers, because many of them are still being bucketed as hedge funds, and therefore ending up in people's tiny little 10% alternatives bucket. And we think that's completely wrong. We think that these managers can be managing your core fixed income allocations and doing a really good job of it. So I'm going to look through the eyes of one of these managers, tell you what they're looking for from institutional investors. Now, as a boutique manager, I'm looking for investors with aligned objectives, total return focused, not benchmark focused, and timeframes, longer timeframes for investing, longer horizons. As well as being benchmark agnostic, I don't want to be constrained by labels or buckets. I want to buy opportunities based on their risk-reward characteristics, on what they bring to a portfolio. I don't want to have to think about necessarily whether something's a bond or a loan. I want to buy it for its characteristics. I want to understand clearly client expectations around risk and reward. I really want to understand constraints about liquidity, what investors are looking for security-wise. This is going to save us some difficult conversations later on. And finally, I want to offer liquidity terms that align with my underlying strategy. So not necessarily even my underlying security. Because if I'm going to have to be a balance sheet lender in credit markets, it doesn't matter that a piece of paper might trade daily, but if I'm going to be a balance sheet lender, then it's not appropriate for me to offer liquidity that's daily or maybe even monthly. I need to have a time horizon that's extended from that. Now that's very demanding. I've been a very demanding credit boutique manager, and what am I going to give you as an institutional investor in return for all those things? Well, I will significantly compromise my economics for an investor like this. I will cut my fees, and I'll work hard to find fee structures that are aligned as well. I'm going to be very keen on finding a fee structure that aligns our interests. And because of that, I'm going to be heavily motivated to limit my capacity to protect performance, protect your performance. In sum, I want fewer, deeper, clearer strategic relationships. And we think this is interesting. We think this is a real win-win because ultimately this is going to lead to stickier capital. This leads to better alignment of interests. It's going to lead to lower fees, and ultimately that's going to lead to better investment performance. That's the money we're looking at there, which is what we all need ultimately. So there's a lot of talk about liquid and illiquid paper, a lot of talk about illiquidity premiums and so on and so forth, but the key really is about aligning time horizons. I'll look forward to potentially taking some questions later on. Thank you very much.
Thanks, Pete.